cost segregation is essentially an advanced form of depreciation, which depreciation is a tax deduction that you get if you own a property. And so we're doing an advanced form of that by looking into the engineering of the building, and each individual component, according to the IRS, can depreciate faster or at different rates. And we're able to break that down, which allows you to get larger tax deductions in the earlier years of ownership, essentially front loading a certain percentage, maybe on average about 20 to 30% of the building cost or of the tax basis that you can front load to those earlier years, which allows you to utilize the time value of money and have larger cash flow in the earlier years of ownership.
And then Bill, can you kind of explain in the net, what does 1031 do? And how does that help you to defer or plan your tax?
Sure. Well, and probably the best way to do it is by example. So in a lot of cases, folks start off with a single family residence, and either as a rental or as a primary that later becomes a rental or an accidental rental. And then at some point they decide they really like this and they're ready and want to trade up to a duplex or fourplex. And then they meet with their accountant and find out that they've had a nice profit and what they're going to pay in taxes. And the 1031 exchange allows them to sell that asset, and they can defer all their federal and state taxes by reinvesting in other replacement property. So it's really all about deferring the tax, keeping all of their cash, their equity in their pocket, not paying federal or state taxes. And that allows them to trade up into larger properties, more doors, improve their cash flow, and ultimately their net worth.
And this is something that anyone can kind of do as long as it's an investment property, right?
Exactly. Anything held for rental, investment, or business use would qualify. Anything with personal use probably doesn't qualify, but it could. We just have to make some changes and change intent and change usage.
Gotcha. Now, very interestingly, and now the reports that produced by Jonas' team, and then the whatever the documents that Will provides for facilitations, and that kind of get fed into Thomas's lab, examined by Mario, and making sure it's all compliant, and that's kind of how the sausage is made. And that's how we give you negative K1s, or in some cases create a tenant in common structure, 1031 into the next deal. Great. So I wanted to ask a few deep questions over here now. So we're going to dive right in. This is definitely not a 101 session. This is definitely a 201 session. Great. So first question I had is, when is the best time to do cost seg?
Sure. The answer is always going to be, when you ask any tax question, is going to be, it depends, right? There's always facts and circumstances.
No, that's why we have this session. There's no depends. Yeah. Okay. Yeah.
It always depends, but I'll throw out a couple of scenarios what those factors would depend on. And one of the things, the great thing you brought up, is when you're doing a major renovation. So if you buy a property, place it in service, I always say, Elisa, it's best to get at least the feasibility analysis, to get an estimate, to get an idea of what the potential is ahead of time, right? Get that done. And then you can figure out, is this going to be most beneficial to get it completed immediately? But the advantage is that you don't need to. It really has a lot to do, and I'll turn to Thomas in a minute. There's tax planning, okay? And that's really what you have to figure out for your situation, or the whole situation of the investors. But in a scenario when you're doing a major value add, you place the property in service, we can do the cost segregation on the acquisition cost. So let's say you spent $5 million on a property. Now we can take that $5 million, we're putting that on the books, and we're depreciating that property, breaking that down, and getting the cost segregation done. Now, after some time, you go and do value add. You go and renovate a certain amount of it. You put on a new roof. Maybe you pave the parking lots. Maybe you're replacing, appliances, cabinets, etc. All of that can now be, not only can what's been written off get taken out, be a tax write-off, but you can now, whatever was spent on the property is now added to your depreciation schedule, which means you can now take the tax deductions of all the money spent. So I always say, if you are doing a major renovation, it's not in every scenario, but it may be worthwhile to do the cost segregation in 2 stages. Okay, and it does depend also on how far out that renovation is going to be. If it's going to be an immediate gut renovation, for example, you really can't do it in 2 stages because you've never really placed it in service per se. So there are, like I said, there are a lot of factors, but it's best to kind of consult and understand the exact scenario. I'll turn it over to Tom, because he's obviously itching to say something that you don't necessarily need to get it done right away also, right? You can get it done retroactively or in future years.
No, I completely agree with what you said, Yona. Like if someone asks me when's the best time to do a cost seg, I would say the best time to get an estimate on that cost seg or a feasibility study is right now, even before you buy a property. And that could even be a useful tool, like if you're trying to deal with tax planning and you're trying to find a new property and use some of the cost seg loss on that new property to offset on a gain you have going on earlier this year. Like it'd be helpful, it'd be a really helpful tool when you're evaluating different properties to just get like a quick estimate. And I don't know how long this takes for you to do, Yona, but sometimes we'll look at the cost seg after something's already happened. And we ask the question like, well, how come there wasn't more depreciation that got accelerated? And well, it goes back to the county and the land allocation was a lot higher than we expected. And there just wasn't nearly as much basis in the building to accelerate. So there's some factors that we can look at, determine earlier on. So as far as like the planning portion, getting as much information as we can, including that cost seg feasibility up front, that is really helpful. But as far as like timing, when to take that deduction, because again, and I'll use an example of a client that Yona and I both worked on recently where the client actually did the cost seg for 2020, and we talked with the client and we said, actually for 2020, you're going to save, we'll just throw a number like $50,000 if we do it in 2020. But next year you've got a large capital gain coming in. You've also going to be making more income from your new business, and tax rates are probably going to be up higher. So factoring in some of those things, if we wait till next year, you're going to save between $65,000 to $100,000 in cost seg. Well, is it worth that time value of money to defer that tax now, or can you wait another 12 months and we'll almost double the tax savings? And so in that situation, we went back to Yona and said, okay, we already did the cost seg, can we just modify the report and have it be for 2021? And that wasn't an issue. They got back with that really quickly. So some of the things that also kind of come up from a timing perspective, in addition to like the time value of money and knowing how much your cost of capital, or how much can you grow those taxes by kicking that can down the road. It's also helpful to know, like, are you expecting any other future gains in the next few years? Is your income going to go up? Are tax rates for your situation going to go up? Is there going to be, I have a lot of clients who they're a tech employee this year, but next year they're leaving Amazon, Microsoft, wherever, and they're going to go be a real estate agent, or they're going to go full-time 100% to the property. So they could be a real estate professional. So that means that big cost seg loss in 2020 would just be a big passive loss that would just get carried forward. But if they wait to do it next year, they could be a real estate professional, and that might offset any additional income or severance they got paid as they left. So those are just some of the factors to throw out, and kind of just re-emphasize what Yona said at the beginning. It depends.
Right. And then, I have some long-term strategy question over here. Mario have been on the receiving end of the cost seg because we have a property that we're currently running, and we do expect to do a lot of work on it. So she's been kind of working on separate it out and asking particularly for particular reports to be done through Yona. And Maria, I don't know if you want to kind of share a little bit about that, like the particular reports that you are requesting, because Yona is very seasoned over here, so he guides us through some of that stuff. But not all cost segregation company are proactive like this, so it kind of takes a little bit knowledge to request for what you're looking for.
Yeah, and this is, and Yona touched to it when he commented, when he was mentioning that it can be done in 2 stages, because you want to identify the portions of the property that you're actually going to be retiring once you replace them, and you get a write-off of this, you get to remove them. And that's important for what? Not necessarily, I mean, it's going to be important for the portions that you have not taken a bonus depreciation on, because those you're being depreciating on a straight line basis, which means you're taking a portion every year. And so you want to identify these portions specifically on your study, so that when you replace them, you can write them off one time as if you had taken bonus depreciation somehow. So that's what we're looking at. Another thing that I like to ask for, and not all the sponsors will do it, is upon the sale, having a look again at the fair market value of what we're selling. And why is that? Is because everybody has heard about the depreciation recapture. And what does that mean? It means that when you have what we call personal property, not the building, but the personal property, and you're selling this, but you have taken 100% depreciation on it, that becomes taxed, recaptured, and taxed as ordinary income up to the amount of the capital gain on that item. If you can show that there is no capital gain, or that the capital gain on that portion is very small, then you limit the ordinary income that you take when you sell. So then, of course, there's going to be a conflict with the buyer. The buyer is going to want to have that up. You want to have that down, but you can usually come to a good place, especially if they're planning to, to replace it. And the IRS really doesn't compare the two. It doesn't, in practice, it doesn't happen. I would be really surprised if someone came and said, no, they looked, but nothing is impossible. But so that's another time where you might want to call back Madison and say, hey, can you just real quick tell me that, Allmark carpet is worth 0 and I can just, take no gain on that. And no sales price is going to be allocated to, whatever my buyer is going to replace.
That's great to know, because as we're exiting the deals right now, these are probably the details. So Yona, do expect us to come back to you on a few things on our deal that is going full cycle over here too. Now, very interestingly, I want to kind of touch base on this. So for a passive investor who is currently invested in a deal that is potentially exiting, which has taken a cost seg before, there's maybe 2 strategies over here that we want to kind of talk about. This is kind of where, Bill, I want to kind of you to ask some of that question. The first one, obviously, is if we have more deals lined up, that will be going through cost segregations and et cetera for the investors, then it's actually a pretty smooth transaction to sell a property. We want to kind of talk about a little bit about penalties, and then how is that kind of then get offset for even passive investors if they continue investing. So, Yona, I don't know if you have any thoughts over there, Thomas, if you want to kind of chime in, how would that strategy kind of work? And then we're going to get to Bill to talk about the intricacy of 1031, the LLC as a full. How does that work? Because these are kind of a different options to offset against. Yeah. So who wants to take that one from the Cossack part? Yeah.
Yeah, sure. Thomas, I don't know if you want to take this, but I mean, I'll kind of get the ball rolling, which is that typically speaking, when you're investing in a syndication, there are different structures, legal structures that can be done. But if it's done through an LLC where everyone has a portion of the equity of the property, then each investor will get a portion of the overall depreciation allocated to them according to their percentage of ownership. And that's pretty standard. Again, like I said, there are different structures that are out there that people can use. And if it's a tenants in common, I will get to that later, I'm sure, but that's the typical thing. Now, how can you use those deductions? That's really important, because as Thomas mentioned before, unless you're a real estate professional, a lot of those passive losses or the passive deductions of depreciation are going to be limited to be used just against your passive income. So if you have rental income, you have real estate income from other deals or other sources, so that's going to be good to offset that. Otherwise, it's just going to be a passive loss. It will carry forward to future years, but you're not going to be able to utilize if you or your spouse are not, or only one of you needs to be, but need to have that real estate professional status to really take advantage of that against any active income.
But in terms of if you were passive investors on a full cycle deal, and then if the deal that you're going to reinvest your proceeds to is also a passive deal that may generate additional K1, then that could be potentially offset full pot, right?
Yes,
if it's in the same year, exactly.
Yeah. And I'd like to comment to this, because I think it's a very important thing. There is always this, indeed, this passive losses can only offset passive income. That's a fact. However, if you are indeed a passive investor in general. You can invest in a deal and get those losses and sell a deal and have a taxable gain. And all of this will be passive, and you can actually offset all the things together. And you can have the investment ahead of time. Like you can invest in a deal in March and have your capital gain in December, as long as it's in the same taxable year, that will work. And generating your losses ahead of the gain or in the same year of the gain will usually work. Something else that is useful to know is that when you sell a passive investment, it actually becomes non-passive. So there's also some opportunity here if you have some non-passive losses in that year to use. And yeah, I wanted to add something and it escapes me right now. So it's actually in the year where when you sell that actually frees up those losses, especially, if you have not made any elections and things like this. And yeah, I'm not going to enter into those details. Maybe if someone has the question, we can enter into the detail of, grouping your rental real estate together, but that usually applies to real estate professional. Yeah, and it escaped me again. I remembered it. And oh, yes, I know what I wanted to say. I wanted to talk to the people who do their own tax returns, because people who are preparing their own tax returns, depending on the software that you're using, you have to be super duper careful. If you're going to be using TurboTax is super bad at looking at matching your passive losses with your capital gains that are coming through a K1. Extremely bad, or your ordinary income coming through a K1. HR block is slightly better, but you do have to know what you're doing. And I think that if there's one thing that I would like to recommend to people here is that if you're working on your own tax returns, the year when you have a sale, I would really recommend to, get the advice that goes with your software, because you want to fill up the Form 8582 properly. If you don't, you're going to miss out big time, and you might end up paying taxes that you don't owe. That was the super important part that I want to say.
And who does their own tax right now? I'm just kind of do a poll. You can raise your hand on our attendee list. These are maybe some special people we need help. All right, Jonathan, you got taken care of. I need to go talk to Thomas. Okay, great. So I have now coming and looking at the strategy. I think there's a couple things I kind of picked out here. One key segment is that this gain and losses all has to be in the same year. So then it becomes super important. If you're exiting the deal in November or December, you want to make sure contact your sponsors and etc. Hey, is there another deal in the pipeline? That is actually something that you need to do, or you to avoid, frankly, looking for a deal coming December, because a lot of brokers are not working anymore. They're on vacation, they hit their quota, whatever. So, and then some of the syndicators are done. So right now it's the time. If you try to get a deal done before the end of the year, there's active parties that are playing around to make sure the transactions are happening. So there is a frenzy of properties exchange hands during this time, because it takes 60 days, 90 days to close. So this is kind of like something to talk about. And then if there's a refi or a sale coming down the line, you want to make sure that you check with your sponsors and making sure they have other plans lined up for this. Now, in terms of Thomas, what do you need to estimate if a syndicator come to you to say, hey, look, I have another 2 deals lined up. I have 2 deals lined up, and then I'm exiting this deal. What are you looking from them in order to help prepare their passive investors to make sure the transition is kind of smooth?
Are you asking about the project I'm helping with right now? We're doing something like that right now. I looked at prior year tax returns to see what depreciation's already been taken, plug in the estimated gain that's going to be coming through on the property. And I say gain, but that's different characters of gain. Like there could be some recapture, like Muriel talked about. There could be what's called Section 1231 versus Section 1245 gains, and that knowing that for the K1 investor, the passive investor on those deals can be relevant to their specific situation. But essentially what I would try to do is try to figure out of this gain that's going to be determined, how does it break down, and then let the investor know here's all the buckets of gain that we're estimating. And then if there's another project, then say, okay, well, here's, like we'll get the estimated cost seg from Yona and say, here's what we're looking at for bonus depreciation. And probably I would assume like the operating profit or loss is probably usually a wash in the first couple of months at the end of the year. So it's really all about like, what's that depreciation going to look like for the first year? And that's going to be a function of the leverage that is on the property. So how much cash is an investor putting in and the leverage on that deal, along with how much can they accelerate into bonus depreciation for the cost seg.
Got it. Yes, selfishly, I'm asking the question because I'm kind of doing that right now. And I'm sure Yona's getting all these contracts too. So now kind of turning the tables a little bit over here, Bill. We've got a question from the Facebook Live over here. So we want to kind of ask this question too. And then you can kind of explain about 1031. So how does 1031 then come in as a potential alternative, for this type of transaction? Because let's say, well, we're selling the project in November. We really couldn't find the thing for investors to get into before the end of the year. And it has to kind of spill over, but we know we have a deal that spilled over into January, right? So this, I feel like that's where a scenario where the 1031 can come in really handy, because it's also another tool that we use to defer, because we're bound by the calendar year with the cost seg, but with the 1031, you're bound by some other timeline, right? So can you kind of share some of that basic rules, and then talk a little bit more about what does it take? Because the often common question we get was like, can I 1031 my large pot into a syndication, or can I 1031 out of a syndication? So what are some mechanisms to do so?
My favorite answer, it depends.
Yes.
So with 1031 exchanges, of course, you've got very specific deadlines. So when the sale of your current property closes, you've got 45 calendar days to identify what you're going to acquire, an additional 135 days to actually complete that, for a total of 180 days. But there's a lot of confusion, a lot of misinformation surrounding that. So for example, in a lot of cases, most people want to defer all of their taxes. So they're going to sell, and within that 45 days, they'll identify an asset that's worth equal or greater than what they sold. So they're reinvesting equal or up. They reinvest all their equity, and it's all tax deferred. When they say it's all tax deferred, there's always some items on the closing statement that are probably going to trigger a little bit of tax consequences. You always have non-permissible expenses, prorated items, property taxes, interest, things like that, that would probably trigger a little bit of tax. So when you're doing an exchange, just know there's going to be a little bit of tax no matter what.
Unless if you proactively knowing these are the item that's coming to place, and you kind of bring them to the table when you close, which is something that we, like gymnastics that we do oftentimes with you and Thomas, making sure custodian on that. Yeah.
So a couple of days before closing, get a copy of your estimated settlement statement and sit down and go line item by line item, add up the non-permissibles. And you could put, exactly like you said, put out-of-pocket funds into the closing, and that'll offset it so it's not taxable. The other thing a lot of people don't know, since we're coming up on year end, is Section 1031 works in conjunction with Section 453. So the 1031 exchange is really like an installment sale. So in cases where you're doing a partial 1031 exchange, or you have a failed 1031 exchange, if your 45th day lands in 2022, or your 180th day lands in 2022, depending upon the circumstances, it may push your gain into 2022. And you also have the ability or the option to elect to take the tax hit in 2021. So it does give you some year-end planning. And, going back to your comments where you may have a gain coming up, but your loss or your offset may not be until next year, that may be one way to do it, is set up an exchange, go through the process, and it ends up failing, it pushes your gain into the following year. That was a lot easier said than done. Now with the Biden plan to increase capital gain taxes, that kind of mixes that up a little bit, but that's an option too, is to use that as a year-end tax planning strategy.
Oh, learned something again today. That's neat. That's a very neat trick. Yes.
And if you read a lot of the information in brochures and on websites, a lot of times it says you have to trade equal or up in value. You have to reinvest all your equity. You have to replace your debt. Well, that's true if you want to defer all of your taxes, but in a lot of cases, people want to pull cash out. It's the old adage, you're real estate rich and cash poor. So some people want to create some liquidity. Other times they're getting rid of debt, or there's all sorts of strategic reasons why you may do a partial exchange and trade down in value. And it's perfectly okay. You just have to plan on, whatever tax consequences you're going to get hit with. And then we have a lot of clients who, do the exchange. They may identify 2 or 3 assets during their 45-day window, and they're trying to decide what to buy. And that's where Yona can come in and do kind of that estimate and say, here's the 3 properties you've identified. Here's a quick estimate on what you could save if you do a cost seg on any of those properties. And that may help narrow down which of the 3 they want to actually go forward with and acquire.
There you go. I think a lot of people says the Cossack and the 1031 is interchangeable, but there's also instances where the 2 can kind of work really well together. We had a question on the Facebook Live. This is a gentleman who looked like was able to put a property under contract in 50, 52, 53 days or so. But the negotiation of the contract went on 9 days. So in this case, when I would consider they have identified the property within 45 days, right? Like with that, would you say that versus like the actual fact that they put it under contract is more than 45 days? How do you take these cases? Are they still eligible, or is there a 1031 kind of got toasted?
So in this case, they didn't identify the property during the 45-day window. They were working on the contract, but it didn't get inked until after the 45-day window.
Yes.
There's a risk with that. The identification process has to be in writing, has to be signed. The gray area is that the regulations say it has to be made or delivered to a party involved in the 1031 exchange. Well, what does that mean? So in a strict interpretation of that, a party to the exchange would be the qualified intermediary and the taxpayer. Those are the 2 parties that are part of the agreement, period. So we think it has to be to the qualified intermediary if you want to be absolutely safe. Now, can you identify to your escrow, your title, your broker? Maybe. It depends on how the IRS would ultimately, define a party and interest. But if all you've done is entered into a contract and you started the negotiations during a 45-day window, I think you got a problem. I think that would be disqualified under audit. Even if you went under contract during your 45-day window, I think you've got a risk. I think you've got a problem. I think the only time you might have an argument is if in the contract you specifically state this is my replacement property for the 1031 exchange under exchange number 12345 that Exeter 1031 is handling. That might fly. But if they just go under contract, people buy and sell real estate all the time. So unless you specifically identified that this is my replacement property for that 1031 exchange, I don't think it's going to work.
Yeah, and then this is an important part to say too, is like all this tax stuff is like you got to do this ahead of time, right? Like for example, if we're buying a property or selling a property, we contracted Thomas way ahead of time of our sale to say, hey, we need to do this estimate. And Unit 2 is like before we even take it out to the investors, that he's already got the estimate to me. And then to your point, Bill, too, it's like if you have a 1031 exchange, you need to engage a 1031 facilitator, which is your company is one of them, ahead of time when you're selling the previous property, ideally, or maybe even before then. Like oftentimes I call Bill before I even got any contracts undersigned on the sell side or the buy side. But I'm like, hey, this is what I want to do. And then we get on this long discussion, coming back, I'll probably need to have a drink to unravel. And then, it's always a challenge to my brain cell. And then we go ahead and execute the whole plan oftentimes. So that's important to definitely get in touch with Bill if you're thinking about 1031 exchange to get the facilitator involved before you actually doing any of these transactions. Yeah.
That's a good point, because a lot of times what we hear people say is, oh, don't worry, we closed, but I told the closing agent, don't disperse the money because I'm going to do a 1031 exchange.
Oh. The
problem is the closing triggers the gain. And even if you tell them don't disperse the money, you have the right to the funds and it's taxable. But we get those calls literally every week. It's sad. We're always telling people too late. So sorry.
But there is a mechanism that you could do, maybe a reverse 1031 if it's worth saving, right? Which is when you got the next property under contract and then you have the cash to buy both, and then somehow you got a reverse exchange working.
Yeah, the reverse exchange really allows you to buy your replacement property first, and then you can worry about selling your existing property. And you might be able to layer them. You may start off with the forward exchange and go into a reverse exchange and then go into a forward exchange. And right about then I get a massive headache, but no. But it is possible to layer them. You can do all sorts of combinations to achieve different solutions.
Yeah. So now question over here is for a syndicator. I know this have been done with a lot of headaches and nightmares, that you could actually technically 1031 a property that you syndicated into the next one, right? So tell us a little bit more about how that could be done as an alternative.
Sure, and that really falls into the it depends category. There's a lot of moving parts there. So what investors have to realize is when they're doing a syndication, most of the syndications are structured as an LLC. So you become a member of an LLC. There's multiple members. So now you're really technically a partner in a partnership. So when the partnership sells real estate, the individuals have not. The individuals are just getting cash distributions from the partnership, and that's not exchangeable. So there are all sorts of potential solutions for that. The one that everyone seems to automatically gravitate to is what we call a drop and swap, where they take the property, deed it out of the LLC into the individual's names as tenants in common, and then immediately sell and do 1031 exchanges. And that has significant risk to it. It's been done for years, and if you go way back, that was kind of the go-to solution. But the IRS in certain states, especially I'm in California, California is nasty when it comes to drop and swaps. And the issue is you drop property out as an individual, you didn't really intend to hold the property for investment. You took title just to sell and do an exchange. So you're really holding it for sale and it won't qualify. There's all sorts of possibilities there where we can try to change the ownership structure and get it to qualify.
Gotcha. And then one thing that you have shared with me, which is very shocking with me, is I always thought that when you do a 1031 exchange, you need to remain at least 50% ownership. And I believe on our last conversation, can you kind of get into this a little bit more? On our last conversation we have had, sounds like that may be just an urban myth.
I'd say that again. So you mean if it's a syndicate?
If you have an LLC that you're 1031 forward, and it used to be that the misnomer was that you have to retain 50% of ownerships.
Gotcha.
The 50% ownership has to kind of stay together. But you mentioned that perhaps not the case.
Well, it was the case prior to 2017, and then the Tax Reform Act of 2017 changed it. So when we're dealing with partnerships, we used to be careful not to change more than 50% of the underlying members or partners in the entity. And that always created issues. But the 2017 Tax Act changed that. So now there's not a 50% requirement. So what we really try to do in solving some of these issues is if we can drop people out who want to pay the tax, do like a redemption agreement or something along that line, and then keep those who do want a 1031 exchange inside the LLC. It's the same LLC, same partnership, same taxpayer identification number. We've just changed some of the underlying members. Now the same entity can say it did hold the relinquished property for investment and it did acquire and held the new replacement property for investment. That could work. But if we can't say it's the same entity, same taxpayer, then we've got some risk.
Gotcha. So the conclusion is in order to defer it again, I mean, if you're going to cross the calendar year, perhaps explore it into the 1031 exchange realm. But if you're going to keep it inside a calendar year, perhaps using a cost segregation and a great CPA, estimate, and then a proactive syndicator that kind of helps in facilitating that would potentially be a easier solution than getting everybody in the LLC to sign kind of the redemption agreements or whatnot. Yeah, great, awesome. Now, question over here, because I know some of our listener over here was talking about. Actually, I have my own question that I want to ask too over here, which is always the fun part. Now, we have kind of thought about bring over offers to our investors and do continue 1031 exchanges. And until the pot has grown to a certain sizes, and then puts it into a yield vehicle and refinance. Now, in this scenario, there's always a party always comes to an end. So as all these years accumulate the taxes, whether through cost segregation or 1031 exchange, because it's all tax defer, not write off, what will be an exit strategy for something like this? And then this is kind of invitation to both Bill and Yona Thomas to kind of talk about very interesting concept.
The individual investor who's anticipating a
The
really large gain,
LC that holds the property itself.
strategy for the LLC.
And then also
And
for the investors, yes, the individual investors eventually we need to exit. So what are some tax planning options that we can do over there?
I mean, the way I'd first approach it would just be, first let's estimate, if we don't do anything, what's that tax going to look like, both on the LLC level, then let the investors know, hey, here's what we're thinking of, and maybe even solicit feedback. But I've seen several times where clients did what Bill just explained, as far as like, let's redeem out some owners, or let's turn this into a tenancy in common and drop out some of the ownerships. I've seen both of those scenarios. And because maybe some of the investors, I mean, it always comes down to the case. Some want to sell it and take the gain, and some want to defer that gain into a year where it's not going to be as bad of a tax hit. And then also, on the next property, whether it's a new real estate property for the investor, or if that's going to be a new property in the LLC level, doing a cost seg is going to be beneficial. And I've seen a few instances where an LLC, like a syndication, would do the 1031, but it deferred, it rolled over the appreciation from the old property. So there's more cash into the new deal, essentially. And so they had more debt that they could take on. So they had more debt basis, which meant not only did they defer the gain, but on the additional basis they just added with that debt, they did another cost seg, and we got some more negative K1s in that year. So yeah, so long as there's more debt or more cash going into that post 1031, there's more basis usually to do another cost seg. So those are some of my initial thoughts.
Got it. So it could be a combination of that, depends on where it falls in the calendar year and what individual investor status. At some point, like 10 years down the line, maybe all of them gets converted into real estate professional. And perhaps that opens up, not whole can of worm, but like whole can of good worms, potentially to use cost seg as well. Now, Bill, is there any updates when you're doing a top 1031 exchanges? Let's say people who has done this for 10 years in a row, or 10 1031 exchanges in a row. At some point, I know there's some new Biden taxes that may impact this, where inheritance taxes kind of come in, how that kind of gets into it. Also, Yona, like in terms of cost segregation, when all the taxes defer through depreciation, is there a way, that can kind of get into the inheritance tax, etc., that could offset for not the person who's alive, but for the children and etc.
Sure. The good news is the House Ways and Means Committee came out with their markup, I guess about 3 weeks ago now, and 1031 exchanges were not included in the markup. And so that was our goal, is to keep it out of the markup. So at this point, there are no proposed changes that would affect 1031 exchanges. And there's always a very slight chance they could add that back in, but at this point, it's very rare. So at this point, we think the 1031 exchanges is saved. There's all sorts of other stuff in there. And for any of your listeners who, for example, are using self-directed IRAs, there's all sorts of nasty stuff in there that's just ridiculous. We've won on the 1031 exchange side, and now we're fighting the fight on the self-directed IRA side.
Mm-hmm. And then we have a question about that specifically, and I have a follow-up question to that too. But Yona, do you want to kind of chime in to say, like, in terms of defer the taxes, because there's also the penalties, the cost segregation penalties, so you're kind of kicking down the can down the road. So what are some good ways to kind of minimizing that capture at the 10th project, whatever that you're doing down the line?
Yeah, I mean, I always want to try to find your next investment, right? Like Muriel was talking about earlier on, if you can have other passive losses in that year to offset the gain, then that can be a great strategy. You're talking about exit strategy. One specific thing, and Muriel also mentioned this earlier on, is when you've done the cost segregation already, so the recapture tax, there's actually a way to minimize that on the sale for some of those items, those 5-year property items, which normally would be taxed at a higher rate. But if you've held the property for 5 years, or at least a minimum of 3 years, in my opinion, but 5 years, you can do something what's called a partial asset disposition on the sale of the property, which can actually allow you to reduce the value of those individual items that you essentially written off. So for example, if we're saying all the appliances depreciate on a 5-year schedule and 5 years have passed, so essentially from a tax perspective, there's no real value left in those things. on the sale, you can actually file this, what's called partial asset disposition form, allows you to reduce the value of those items. And so therefore that's going to lessen the burden of the recapture tax. So that's one strategy I know a lot of accountants use to that not a lot of people know about, believe it or not. So that's one. But again, if you can always have another deal in the same year, that's going to be the best.
And I'd like to ask a question to Bill, just to make sure, clarify, but the personal property portion, the 1245 property, that doesn't go into the 1041, is that correct?
Correct. It used to, before the 2017 Tax Act, we used to do a lot of personal property exchanges. That was effectively eliminated. So there's only 2 or 3 exceptions, but at this point, 1031 exchanges only apply to actual real estate.
Yeah, so it's even more important to try and apply that strategy that Yona just mentioned, or try to find new investments that are outside of the 1031, because you will still want to try and offset that portion of the gain, which is going to be taxed as ordinary income. And I just wanted to, because words are important, but earlier I mentioned, when you sell something, it becomes non-passive. It's not exactly that. It's your losses become unsuspended and can now offset your active income. And so that's a little bit different, but I just wanted to not leave any kind of questions here.
Good. Thank you so much, Mario. So then let's kind of talk about this a little bit. Actually, I want to touch base on this one too, is like some creative strategy over here when I'm kind of get my brain thinking over here is, Bill, you mentioned to me before that I can swap a member, as long as the entity, like if it's a partnership, you have 2 people, you still kept the more than 2 people, that wouldn't trigger a tax event potentially. So it's possible theoretically, me and Mario, let's say we're a partner in one deal together as partners, and we 1031 exchange at some point, cash out our investors, and then this and that. Or let's say something that we just got in together, and then we can decide that actually we're going to add our children to this, right? Like as partners, and then eventually we sell the share slowly at a time over the years, and then it wouldn't trigger too much of a gain. And then eventually they buy us out. So it would be a small tax event, but then they now owns it. Like, could that, multi-years, 20, 30 years of planning, could potentially kind of be a good strategy for this when we're wanting to kind of leaving a legacy for our kids?
It could be, especially investors who want to gift the property to their kids little by little. You value the property every year, and you can gift the $15,000 per person per spouse, and then you just assign a larger percentage of the LLC to the kids, and so a lot of times they'll do that. When we're dealing with partnership issues, in some cases it's a 2-person partnership. One wants out, one wants to stay in. So then they may have to add somebody to the partnership, then redeem somebody else out. And sometimes the people you're adding to the partnership are your kids. So you're not only solving the partnership issue, you're also doing some estate planning issues at the same time.
Great. Awesome. I think we have a couple more questions over here, and then we're going to try to wrap it up. But I mean, this is a session I can be in for like 5 hours. And, really kind of get a glimpse of all the people that we work with and the caliber of people that we work with over here. So Federico had a question about the implication of new tax policies on self-directed IRA towards investing on real estate. So Thomas or Mario, can you kind of give us a really brief summary on what is kind of on the chopping blocks over there? Why it's so nasty? Everybody's crying.
I might actually defer to Bill because he alluded to it a couple times, but I know that there's Roth conversions. It looks like, unless it was a typo, it looks like those might start to sunset in 2031, and then there's after-tax contributions that maybe next year, so you can't over-contribute after-tax to like a 401k at Amazon or Microsoft. Anything else?
So yes, I understand the question, because what has been announced is pretty horrifying, and we have still time to fight it. And I'm going to share a link in the chat from a tax lawyer that has been preparing some letters that you can email your representatives. It's very important that we try and stop this. So basically what they want to do in a nutshell is kind of kill the self-directed IRAs. You will not be able to own any more than 10% in anything. You will not be able to invest in anything where you, like, for instance, a syndication. You know how you invest through your self-directed IRA, and you can do that because they're going to look at if the IRA is qualified based on you, the owner. They're going to say, if you're accredited, then you can invest as an accredited, the IRA can invest as an accredited investor. And if you are sophisticated, then the IRA can invest as a sophisticated investor. That is going away. You're not going to be able to own any more than 10 million total in all of your retirement plans. And if you do, you're going to have to take mandatory distribution of half of the excess every year, no matter what. So say you have 12 million in all of them, like your employment 401k and your IRA and your SDIRA, you're going to have to take a mandatory distribution of $1 million. And they say, only if you have an income of more than $400,000, that their magical number. But frankly, it's crazy. So I'm going to drop that link because it's and if that passes, then basically you have 2 years to get out of all of your investments. I don't even know how in practice that can be done, because all of the syndications, I mean, it's not that easy. So I'm going to share that link. It's called Hands Off My IRA. And that is, a tax lawyer that has spent a lot of time on this. You can go there and print out those letters and mail the representatives that are named, and your own representatives as well. Make noise about this, because this is, it's not only for real estate, it's for everything that's in there. So if you're investing, in anything through your IRAs, if you're doing like note lending, or if you're doing crypto, if you're doing gold, no, you can't have that in an IRA, but if you're doing, anything.
You could. There are ways to do it.
You basically cannot build your retirement anymore if you plan to live until you're 100 years old. 10 million is not enough. That's how I see it. So it's not good. So that's the summary.
I think a few solutions. Obviously, follow the link over here. Be an advocate. Call your representative about this, about your own retirement money. But a few other solution I kind of just thinking about over here is, like, if you're using that to kind of invest into syndications now, you kind of have a runway of 2 years, it sounds like, over here. So make sure you invest in deal that kind of exit in less than 2 years if you can predict it. Or, having a plan in the 2 years, we kind of talked about the planning ahead, in the 2 years runway towards that. Having a plan to kind of get out of your IRA, because you could, for your real estate professionals, you actually have maybe some more options to play with, a combination of cost segregation, 1031 exchange and whatnot. You can sell some of your personal asset or convert it from your 401k, pay the penalty, convert it into a real dollars, cash, and then kind of invest in something, use Cossack to kind of offset some of that. So obviously this is very complicated. I'm going to defer to talk to your CPA, to really kind of plan this ahead of time, to get that money out there. Knowing that I have a big chunk in my retirement fund, so I'll be looking at all these strategy myself as well for that, because I know some of our investor invested with retirement account. This goes for solo 401k, self-directed IRA, any of these vehicles. So don't just think this is one of these things that you're safe in the solo 401k. This is kind of all on the chopping block over here.
These provisions were actually included in the bill in the markup. So this is not something where we have 6 or 12 months to fight. This is something that can happen very quickly. The attorney in the link that she shared is fantastic. He's got a great little website there, so that can certainly help and give you one way to copy letters and really write. But they need to hear from all of you. It's critical, and you need to do it quickly, because this could pass very quickly, or it could drag out for months. But if you don't do something, that's when they sneak up behind you and pass it.
Yeah. And then it's not a very common cons people have. So therefore the resistance lobbying against it is not huge. So that's like something that you really need to kind of take into account and fighting
There's
for.
kind of a coalition that's forming, like the Institute for Portfolio Alternatives, or IPA, is involved. RETA, the Real Estate Investment Trust Association, is in there, and a few others that are forming the coalition and kind of pooling the resources.
Yeah, definitely. Hey,
Uh-oh.
so we have so many more topics to kind of cover over here, but I want to kind of touch base on a few like scenarios over here and then kind of wrapping up our session. Again, we're going to send the recording of this session out. And also, if you want to understand Cossack a little bit more, or what is to be a real estate professional, what is the advantage of that, using the Cossack in 1031, we have videos that we have made in the past, which we will send out as part of the recording with our speakers over here. Okay, cool. So my next question is, can I have cost segregation in 1031 performed on a single asset? And then in what way kind of makes sense? And in what way I should be like slapped on my hand? Here's a specific scenario where I was thinking about on my first leg of a property. I'm not sure if we're going to do a 1031 year yet. So I'm going to automatically do a cost segregation because that's what we do for our projects. But then later on, I say, okay, you know what? This project has done within a year or two, and I plan on 1031 it because now it kind of makes sense. I have only 20 investors, and it's a very easy thing to kind of 1031. Now, if it's 200 investors, forget it. Like, I'm not gonna go do all that signings and all that stuff for that. Now, in this case, what I should be, aware of, when do I get to take doubled again because now I'm deferring it, right? And then I also took the Cossack on my first year. Like, what is the consequences if I do that?
There's a lot of moving parts there, so the answer is it depends. But in a lot of cases, if the asset you're selling as your relinquished property had a cost segregation performed on it, you're very likely going to have to do a cost segregation on the replacement property when you acquire it. People today, because personal property no longer qualifies for 1031 exchange treatment, they kind of freak out and think, oh my God, they don't play nice together, and they actually do. So, if you've got a relinquished property and you've got you did a cost segregation and maybe there's going to be some recapture there, et cetera, that's not the end of the world because you're buying another replacement property. And in a lot of cases, you're going to get bonus depreciation or 100% write-offs or whatever. So it's all about planning on both sides of the equation to see how it's going to affect you. And when the dust settles, it's probably not a big deal. You could, with the proper planning, you'll probably work out okay.
Gotcha. So I may have orders coming your way soon. This particular scenario, Bill knows anytime he comes to my webinar, if I ask any complicated question, he's gonna get that 3 months down the road. Yes. Okay.
It's
So
coming.
yeah, yeah, exactly, right. And then so this question is kind of going and wrapping this up is I'm gonna run a few scenario over here. Maybe we do a quick yes and no. And anyone can kind of chime in on this from a panelist. So question, if I have an IPO investor, could some of these passive losses offset their IPO gains?
So they just participated in an IPO and they're a real estate professional. I would say make sure you get some sleep, and yeah, that would work. But
I'd like to throw
Very
something
unlikely.
in that we have not touched to at all, which is still pretty efficient, which is the opportunity zones. Everybody has heard of it. I'm going to try and summarize it in a nutshell. So opportunity zones are zones that have been designated all over the country by the government, are zones to be developed in priority. And they use census tract for this. And what that means is that a lot of them are in poor and developed areas, but because they use a census tract, they use like a very broad Sharpie to delimitate this, and you have some opportunity zones in really nice areas. Like Elisa, you're familiar with this market, the Tempe,
yes.
Mesa, like Phoenix.
I have a property in Scottsdale, prime location. It's an opportunity zone. Yes.
And so anyone, and what opportunity zones allow is you're not going to get a lot of deferral on your capital gain. Right now, it's going to be deferred until December 31st, 2026, at which point it's going to get taxed. However, what you still get a 10% haircut on your capital gain until December 31st of this year, because you need to hold the fund for 5 years. So that's the last year where you can invest and get that 10% discount on the basis. But anything that is in there gets to grow tax-free if it's qualified, if it's a qualified fund and a qualified opportunity zone business property. And the fund itself can be your own LLC if it's set up properly with the right operating agreement language, and you have at least 2 members in that LLC. It cannot be husband and wife in a community state. You can have your own fund, drop your capital gain in there. You have 180 days to do it after the capital gain is realized. If it was business property, you even have 180 days until the end of the tax year. So even if you sold this, like say in January this year, and it was business property, you have until June of next year to set up your fund, drop your money in there, and then from there, you have 30 months to identify your investments. And so it's a very powerful way to kick the can down the road for that particular gain. But more importantly, if you hold your fund for 10 years or more, you now get to sell anything that is inside tax-free. Your property, your no capital gains, your businesses will get taxed normally. There's no cut on the income taxation. Anything that is inventory, like if you're doing flips, it's not going to work. But anything that would generate capital gains, you get a haircut. And the beauty of this is that it's going to work until 20 years, I believe, and you can buy and sell in anything that is qualified in there. You're going to get home free, and you can take the depreciation using cost segregation. It's the best of a lot of world, and you get to, unlike 1031, when it has to be real estate, you get to take your IPO profit and put that into the real estate, and that works. So you have to talk to someone that is specialized for that, because it's
definitely
very highly specialized. And you know, if anybody needs that, I have some people I can refer them to. So.
Cool. And then, okay, so going back to our yes and no questions, how about selling a company? Because that could be a passive gain or active. I don't really know how you categorize it. You know, selling a company, just like selling a property. If you sold a company, is there anything that we kind of talk about over here by reinvesting that into real estate? Could that then be offset your potential gains from selling your company?
So it's the same thing. If you're a real estate professional, then you can maybe get to offset your losses. If you have set it up in a certain way, like if it's a C Corp and it was shares were originally issued and it's like respecting certain criteria, you can actually get home run with complete exemption. That's called a 1202 exemption. Opportunity zones will work again there. But it really depends also on what type of business it is, like what form it was. Was it a solo business? Was, you know, so there's a lot to look at. It always depends. There's always a way, but you know.
I get it. It's the favorite word. Okay, selling your primary home. We get mega $1 million houses when we're selling this. 1031 exchange would not work, right, Bill? But
It could work.
it would work?
It could. It depends. So,
oh, if you turn it into an investment property.
Yes.
Like
exactly.
sat on maybe for 2 years or whatever.
Yeah.
And then Yona, could Cossack work to help us defer that?
I mean, if it's not, if it's a passive gain, then yes. But if not, I mean, if it's a business, then not. I mean,
Yeah,
it's
primary
active.
home. I think through appreciation of the primary home, I think that would be a passive.
Right, you can't do, yeah.
No, you can't do that. But if you invest that into real estate and you're a real estate professional, then again, you have that same
The
thing.
negative
And
thing.
also, if you plan in advance, if you know you're going to sell your home, there are many things you can do. And again, I think Bill can help here, because you can do some family deferred sales trust there. That is a little bit of an advanced technique, but that, you know, if you can sell the property to a trust with your children as the beneficiary, and then that has to be held for 2 whole years, and then the trust itself can sell and like have a step up in basis at the time of the sale, and then you can use the installment sale to try and get, well, so it's, there's a lot of engineering that can be involved. There's always a way, especially if you know it in advance and you plan
Try to
enough time.
sell it. Yeah, sell it
Yeah.
in the beginning of the year would definitely
Yeah.
helps because you get more options. Great, awesome. Well, this is an awesome session. I have so many more questions to ask. Specifically, we're going to post some of these over there. For example, I'm very interested about Delaware Trust. That opens a whole can of worms. So Bill would not go there. But I do know there are syndicated funds that currently are taking Delaware Trust funds, and they're kind of putting that all together. And so this may be an answer for, could you 1031 into a syndication deal? So through some really complicated methods, that is potentially possible. So this is kind of getting the 300 level. We're not going to cover over here. And then that's certainly something I will be following up with Bill and Yona and Thomas on in terms of kind of strategizing that. Well, thank you so much for awesome sessions over here. I think we have one more question from the audience, and then we're gonna head off because I need to go catch a plane. What is the disadvantage of Cossack? Is there any disadvantage to Cossack?
I mean, the main disadvantage would be two things. Number one, if you don't have any income, right, then you don't need extra passive losses, right? And that would kind of go along with the fact that in many cases, if you're not a real estate professional, you may not be able to maximize from the consolidation. Although, if you're just using it, like for in your example, you're investing in syndications for another way to get income from another stream of income, and that income during that hold period is going to be essentially tax free, then it's still a great opportunity. Less advantageous than if you're going to have a The other thing would be is if you're really holding very short term and you're not planning to do a 1031 exchange, because the recapture tax is going to be very quick, right after that. So it all comes back to what we talked about the whole time over here, which is tax planning and speaking with your professionals and making sure you have a plan and a strategy.
Perfect. Awesome. Well, thank you so much I know it's tax season, everybody's busy here. Thank you so much for attending our webinar today. And then we're going to be shipping our recording along with the 3 bonus videos that we have made in the past with Bill, explaining all this mind-boggle 1031s, all different vehicles you can do with that. And then also with Yona, explaining all the details on the cost segregation, depreciations, risk the professional versus not. Also Thomas, the past videos we made together, what it means to be a real estate professional, all that stuff. So we're going to be sending all that link out to you along with this recording as well. Thank you so much for attending today. Thank you.